You can start, right? Okay.
Again, new session.
No, you don't have to check against.
Okay, start. Okay. So we are going to start ratio analysis. In that, first one is liquidity ratios. But before that, what is ratios? When we talk about ratio, what is it? Proportion. It's a proportion. One numerator, one denominator. Like yesterday, what we did, vertical analysis, horizontal analysis, denominator, numerator into 100. That's the ratio. What we did yesterday is also ratio. But when we start these stories of ratio analysis, we want certain meaningful ratios. Meaningful means that have a logical relationship. Numerator and denominator should have a logical relationship. Anything can be ratio. For example, meaningful ratio is what yesterday? Gross profit divided by sales. That is a meaningful ratio. Sales divided by gross profit, that is also ratio. But does it carry any significance? No. So gross profit as the numerator, sales as the denominator, it has a meaning. Like yesterday we got 52% gross profit from 62, it went up to cost of goods sold came down and gross profit went up. We told the story about it. Now, all these series of ratios, what we are going to start, 8 categories and around 35 ratios to follow. These are all meaningful ratios, IMA approved ratios. I will show you here, I will send the PDF later on. Like, for example, liquidity ratios. What is denominator? What is numerator? Everything we are going to understand. And then series of ratios. Around 35 ratios we are going to study. So first, write down liquidity ratio 1. Current ratio equals to current assets divided by current liabilities. Next, quick ratio or acid test ratio. Numerator will be cash plus marketable securities plus account receivable and divided by current liabilities. Next, cash ratio. Cash plus marketable securities divided by current liabilities. Next, cash flow ratio equals to operating cash flow divided by current liabilities. Next, net working capital ratio equals to net working capital in bracket current assets minus current liability, close bracket. You're in the numerator, net working capital in bracket current assets minus current liabilities, close bracket, divided by total assets. Total assets. Okay, some of these are all basic ratios. You have studied that in your graduation, post graduation. This is nothing big. Last one. Here. Net working capital in bracket current assets minus current liabilities, close bracket, divided by total assets. Okay, done. So these are the 5 ratios we are going to study in the first category of ratios, liquidity ratios. Yesterday I said not only calculation but interpretation, what it is we should understand. Now some of these ratios you know already in BCom and all you studied. Financial statement, ratio analysis, current assets, all those things, current assets, current liabilities, current ratio, liquidity ratios, and all those things. But here in a professional exam, we not only calculation, we have to talk about why behind the numbers. Always comparison is current year versus last year. In the exam, they will give you industry average also, and you have to compare that and talk about how your company is performing. First of all these 5 ratios, when you see, these ratios measure short-term paying ability. Right? First bullet point. These ratios measure short-term paying ability. Short-term paying ability. Short-term paying ability of the business. And therefore part of the day-to-day operations and business understanding. Day-to-day operations and business understanding. So when we talk about all these ratios, these are also called working capital ratios. Working capital, yesterday we discussed, no? Funds required for day-to-day operations. So operations. So current assets, current liabilities. So to simplify your knowledge, in balance sheet equation is what? Total assets must be equal to total liability plus equity. This total assets has 2 portions, current and non-current. Under US GAAP in America, they show as liquidity first current assets, then non-current assets. In IFRS, opposite. We show non-current assets first, and then we show current assets. So current assets, non-current. Under current assets, what is current assets? Anyone? Define current assets. Within 12 months. That is created in the business and that is there for 12 months or one operating cycle, it is called. Later on we'll talk about what is operating cycle in the next set of ratios, current assets and non-current assets. Under current assets, first is in the order of liquidity in America. First, they show cash, then marketable securities. So balance sheet is the order of liquidity. In American companies, they have to follow order of liquidity, means show that asset first, which can be easily convertible into cash. So under current assets, they will show first cash, then marketable securities, then account receivable, then inventory, then prepaid items. Okay, these are the standard current assets example. So all these things will come here. And current liabilities. So when we talk about total liability, there is a current liability, non-current liability. Together these are called total liability. And then equity. So under current liability, again, current liabilities are obligations that mature within 1 year. Company has to pay. So popular current liabilities, the order of liquidity is accounts payable, short-term loans, then accrued expenses, etc. These are the current liabilities, major current liabilities. Of course, it depends on the company. Now, why I am telling all these things is that our liquidity ratio comes from here. We are analyzing this portion of the balance sheet. All the 5 ratios when you see, they are all coming from current assets and current liabilities section. Okay, non-current assets, non-current liability, equity, we are not talking about that in liquidity ratios. Okay, so if you see this current ratio, simple. Current ratio is what? Current assets divided by current liability. All these divided by. Now, when you go to quick ratio, if you see the formula, what is that they are including? This plus this plus this, correct? Forget about prepaid items. What is that they are excluding? inventory. Inventory they are excluding except inventory. Numerator is except inventory, and forget about the prepaid item. Prepaid item is a book entry. So except inventory divided by, you should not change the current liability. Current liability will be same. Next, cash ratio. Cash ratio is what? These two. Cash plus marketable securities. This marketable securities means short-term investment. Company's excess cash is invested in short-term investments. Because the belief as a finance manager, you should not keep unnecessary cash in your bank balance. Any excess cash you should invest in marketable security, means short-term market. Let the things earn extra income, and then you will keep only what is required cash. In America, the term cash here means cash plus bank. All forms of cash, checks, post-dated checks, demand drafts, and coins, and digital currency, nowadays crypto, all these things. But in America, any company you see, they just say cash. They don't use cash in bank. That means it includes everything. Marketable securities, it is also called money market securities. Money market securities means short-term market. Short-term market securities, you are going to deposit excess cash in short-term market securities. There are many examples. Commercial draft, all those things, there is a separate chapter. We will deal with that. What is account receivable? Debtors. What it represents? Sorry? Customers have to give us due from credit customers. We sell the goods on credit. And we agree on some credit term. After shipping the goods to you, maybe 30 days. 30 days is our credit term. You should pay me in 30 days. Little bit delay is okay. But whichever not collected portion, it is called accounts. Then inventory. Inventory in manufacturing companies include direct material, work in process, and finished goods. Inventory means everything. Raw material inventory, factory, stores department is receiving raw materials. When they purchase, they store it. At any point of time, what is balance left? That is raw material inventory. Raw materials are used in the plant at any time, which is not yet fully converted. That is called work in process, semi-finished or unfinished. Next is finished goods. That is ready for shipping. They're all ready for shipping. Okay, finished goods. So all these things, now once I tell you all these secrets, now current ratio. Not a so big thing it is, calculation, but as we move from current ratio to cash ratio, they will come down because numerator is reducing. When numerator is reducing and denominator is same, ratios will come down, come down, come down. Why? First of all, numerator is changing, it's reducing, and we want to be conservative in understanding this microscopic ratios. These are all part of our working capital management, that is day-to-day management. As a finance manager, it is our sacred job to handle current assets and current liabilities. Finance manager's job is to reduce inventory levels, but not alone. In section B, when we go to section B, corporate finance, we will study each chapter, how finance manager participates in the reduction of inventory levels, reduction of AR, increasing investments, increasing cash. It is finance manager's job to reduce collections, increase collections, reduce AR, reduce inventory level, increase cash, and put that excess cash in investments. Okay, so let's start with the numbers you will understand. For example, first 2-3 questions are direct questions. This is just for classroom discussions. These are not for really for a from exam. They will ask you direct questions. No, we are just understanding what is the current ratio, but we will do all 3 ratios. Primarily out of 5, the 3 ratios. For the 4th one and all, they will give directly the data they will be giving. Let's remove all the 3 zeros. Current ratio. Current assets divided by in the order of liquidity. What is the first one? Cash. 200. Next. Account receivable is there. Inventory, land, accounts payable. So there is no short-term investments. So next one is account receivable. Account receivable is 400. Next, inventory. Divide by. So your numerator is how much now? 1004. Current liabilities, accounts payable 260 plus interest payable 20. Oh, sorry, here prepaid expense is also there. That's 80. So 1480 divided by 280. How much is that? 1480 divided by 280. 5.29. 5 exactly. Land is not the item. Bonds is 5.29, no? 1480 divided by 280, 5.29. Yes. Getting it? So cash is 200, account receivable is 400, then 800 is inventory, then 80 is the short-term prepaid, and divided by 260 plus 20, 280. And bring water bottle. That's it. 5.29. Now, what's the quick ratio? In quick ratio, it is called actually quick assets. Quick assets are what? That cash 200 plus account receivable, no inventory, no prepaid, divided by current liability same 280. 600 divided by 280, how much? 2.1. 0.14. Then cash ratio. Cash ratio is what? Only cash. 200. Yes. There is no other things here. Marketable security is not there. 200 divided by 280. How much? 0.71. 0.7. Now, with the numbers, what we are understanding now? From current ratio to quick ratio to cash ratio, they are reducing. Simple now. We are going into most conservative way of understanding these day-to-day ratios. But only just like this, we are not going to understand many things until we compare to something. For example, current year ratio to last year ratio, or this ratio versus how our competitors are doing versus industry average. How our competitors in our industry, what is the ratio? We are going to. Now, only then we can talk about meaningful ratios. For example, let's put some numbers. If our competitors' current ratio is 3 point, I'm just putting some numbers, 3.7. Competitors' current ratio is 3.7. Competitors' quick ratio is 1.6. Competitors' cash ratio is 1.1. Now, how we are doing as a company? What is this company? Tosh Enterprises. This is, you are a Tosh Enterprises finance manager. You have calculated that. This itself you cannot talk anything until and unless you compare to your nearest competitor, your industry, and I am giving you these numbers now. Now at least some sense is there. We can just understand where we are going wrong or where we are going correct. My first question to you, if you are this Tosh Enterprises finance manager, is your current ratio good? Are you happy? Do you sleep nicely? 5.29 versus 3.7. You feel proud? My question to all of you. Imagine you are a finance manager. You don't feel good. Or no, what I said is, if you start from current ratio to cash ratio, numerator decreases. That is correct, because we are removing inventory, we are removing many things. Now my question to you, forget that. Now just have a look. You are a finance manager of Tosh Enterprises. Your current ratio is 5.29. Industry average, your competitor is 3.7. My first question, is it a good ratio for you? Are you happy? Do you sleep nicely? Are you proud about it? Not proud about it. Not proud. Yeah, compared to industry, we are just concentrate on this. Yeah, competitor in the industry. My question, did you answer? Are you happy with 5.2? Why? So you're proud about it. Huh? Higher the current ratio, it is good. Are you all understanding my question? Hmm. Okay, what is in your mind now? No, my question, Riddhi. Are you happy with 5.29 when your competitor is 3.7?
It's a gut feeling. I shouldn't be happy because I should be lower than my industry.
You just feel that. Okay. Hmm. You feel, no, I'm good. 5.29. Good. Not good. No answer. Good. Good. You're happy. Why you're happy? Number is high, you're happy. Number is high, you're happy. Huh? Because current assets you have high, you can meet current liabilities. Huh? You feel good. But now my second question. In your current ratio, cash is 200. Uncollected AR is 400. You have inventory 800 and some book entry prepaid 8. Now, are you happy now? 5.29. Mathematically, you are happy. Now, please understand my question. Not happy now. Why not happy?
Though we have so much of capital with us and we're not using it on the current side. That's the way you approach the answer.
No, now I made it very clear. Numerator, what numerators you have? You have AR high, inventory high. Huh? You're happy? No, you can't be. Huh? When you are not collecting account receivable, you have to collect 400 from your customers. It is not cash. Are you understanding my English? Huh? And in your current ratio, current assets, you have 800 worth of inventory. It is not converted into AR, it is not converted into cash. You are happy? No. Are you all getting it now? Mathematically, oh, we have a current assets high, current liability low. I am good. No. In fact, quality matters. What sort of numerator you have? Are you getting it? If cash is 1,200, you should be happy. If account receivable is only 100, you should be happy. If inventory is only 100, you should be happy. Are you getting it? Same 1480. Let me make it. Cash 1,100. AR around 100. Inventory around 200. Prepaid 80. Same 1480. If this is there, then you should be happy. Are you getting it? Just mathematically, you should not be happy. Everyone needs cash. To run the day-to-day operations, we need cash. Correct? We need to pay current liability. Now getting it? We need to pay vendors. We need to pay short-term bank loan. We need to pay accrued expenses. We need to pay rent. We need to pay insurance. What is the use of having uncollected AR? What is the use of not converting inventory. Abhyuta, everyone getting it? I'm talking in this small example for last 10 minutes. Being a professional, being a finance manager, this is what you should aim for. Anyone will calculate the ratios. But as a finance manager, what quality of a numerator you have, that matters. Okay, then that's why when we go to, that is the reason we go to quick ratio. In quick ratio, what is that we are interested now? We are removing inventory, cash, AR, and we calculated 2.1. But our competitor is 1.6. Nicely managing quick ratio. Again, here in quick ratio, what we have problem? Accounts not collected. Not collected portion, we are boasting ourselves. Boasting unnecessary current assets, unnecessary quick ratio, high. What is the issue? Is the quality. Cash should increase, accounts will come down, inventory level come down. This is the basic work of a finance manager. This is the good storytelling. If you go like this to your general manager, saying that, oh, we have 5.29 current assets, we have a 2.14 quick ratio, your business leaders will laugh at you. And you are struggling to run the day-to-day affairs because cash is less. Now again you are going to cash ratio. In cash ratio, it is very dangerous. Here it's accounts payable is there, plus the interest you have to pay, and you are left with only 200 cash. If your suppliers, how long they will wait? Suppliers you have to pay 260. But how long they will wait? You can say, come next week, check is ready. But one day they will get angry, no? One day they will say, we are going to stop the supply of raw material. Once they stop the raw material, how your plant will work? How work in process happens? How finished goods happen? How you will sell the goods? For suppliers, you can delay a little bit, but not too much. Now, if your suppliers come and threaten you, how much you have to give suppliers? 260, right? And you have a cash of 200. Now, if they come and threaten you, and they give me, and tomorrow I will not supply raw material, give me 150. So cash is reducing, 200 minus 150, and this 280 minus 150. Cash is going out. So how much cash you left? 50. And how much still liabilities you left? 130. Do you think bank will keep quiet? You have to pay interest to bank, 20. In bank also will take that. Minus 20. You are left with minus 20. 30 divided by 110. Now how much is the ratio now? 0.27. So 0.27 will be your cash ratio. Very precarious situation. Any emergency, you don't have money. No, how competitors are managing, you see, 1.1. Yes.
Based on that, we can say the ratios are.
Yes. And quality matters.
Meaning that cash should be more than
Yes.
security.
Yes.
In that order,
Yes. Yes.
cash should always be the highest.
Highest.
Then market security.
Yes.
Accounts.
Yes. Accounts will less. inventory less, cash more, excess cash invest in marketable securities. Now you see 0.27, very, very dangerous situation. Tomorrow, one worker get accident in your plant. You don't have money for ambulance also now. Correct? Your general manager shouts at you. What kind of finance manager we have? You fellow, you don't have money? In plant, some accident happens. Oh, where is that injury, ambulance, nothing. And you will say, finance manager, you have to escape now. If you switch off phone, tomorrow you will be terminated. Emergency you have. This is finance manager's situation. Job is very hot today. Hot seat. So that is why in liquidity ratio, we start with current ratio, go down to quick ratio, go down to cash ratio. Understand the seriousness. You should be telling good story, and here unfortunately bad story. So right now, as part of day to day operations and its financing, come on, finance manager should aim to reduce inventory levels, account receivable levels, increase cash, invest excess cash in marketable securities, in bracket short term investments. Okay, you see, last 30 minutes I am in this question. This is a direct question, nobody will ask you this. What I said in this section A, storytelling, understanding, handling. Okay. Now, just go ahead. Calculate all three ratios, come on. This is also direct question, not exam question. Just go ahead. All three calculate. Current ratio, quick ratio, cash ratio. Okay, just finish it out. Huh? All three calculate. How much is current ratio? Simple. How much? 2. Quick ratio. Leave this one, leave this one. How much? Numerator will be how much? 600. 600 divided by 600. 1. Now, account receivable also you leave it now. Cash ratio. 300 by 600. 0.5, right? 0.5. Simple. Now, here. Company has a current ratio of 1.5, quick ratio of 1.2. How much is account receivable balance? How much here? Fill in the blanks. Okay, I'm writing here. Current ratio 1.4, quick ratio 1.2. How much is account receivable? From the data, fill in the blank. I'm zooming what is required. Try. Solve the puzzle. Hmm? 26. Got it? No? Who answered? 26. Okay, okay. Online. How did it do? Style. Just like that.
In that, if your current liabilities, total is not,
Yeah,
but
we can get it.
yeah, we can get it 40 plus 30. I mean, total current liabilities in equity will be 100 only.
Okay, look. Riddhi and everyone. Total assets is 100, right? That means total liability plus equity also should be 100, correct? Yes. Now, from 100, if you reduce 40 and 30, you will left with 30 as the current liability. So, current liability 30. Use any ratio. Quick ratio 1.2. Now we got current liability 30. Current liability 30 means numerator quick assets how much? Okay. So, quick assets is how much? Quick assets means what? Cash plus marketable security. Here we don't have. Okay. Plus AR. Yes. 30 into 1.2. Correct? How much is it? 36. Now in 36 your cash is 20. Yeah. Sorry, 10. And account receivable should be 26. Understand? Here cash plus AR is 36, right? 30 into 1.2 how much? Cross multiplication. 30 into 1.2 how much? 36. But you already have a cash of 10. So balance 26 is account receivable. Are you all understanding? Ananya, Lokesh, Naga, Naveen. Getting it? Answer is 26. Vishwa, Shweta. Yes. So this is a total quick assets. 36. Are you all getting it? Understood? Now, how much is inventory? How much is inventory? Vishal, how much is inventory? Huh? 90. Where is 90?
Yeah.
64.
Okay, so I just did cash minus total assets. So that's 90 minus 26, we have gone to 0. That's fine.
But then there is a fixed asset also.
That's fixed asset is not there.
No, it includes fixed asset. Fixed assets, okay, I'll put here. Now how much inventory? Whether fixed assets is there or not, we have to find inventory means which ratio we should use. Current ratio, right? So current ratio 1.4 equals to current assets divided by current liability 30. Therefore, current assets is equal to how much? 30 into 1.4. 42. In 42, you already have 36. Yes? 42 minus 36. 6 is the inventory. 6 is the inventory. So now, 100 minus 42, how much? 58. 58 should be your fixed asset. Yes? Getting it? Total 64 you said, no? Vishal. In total 64, 6 inventory and fixed assets is 50. These are the fill in the blank questions. Okay. Now, how much is company's current liabilities? They have given you quick assets 208, asset test ratio, quick ratio 2.6, current ratio 3.5, sales 1,800, cost of sales 990, average total assets. Huh? Hmm? 80. Come on, try. I will do. I will explain. Not right, not getting it. How much? 80. 80. Not right, not getting. Anyone? Yeah, Abhyuta, C 80. 80. Yes. Okay. Now, in all the ratios, current liability is the denominator. Correct? Now, what they have given you? Quick assets. Means you should use which ratio? Acid test ratio. Right? Acid test or quick ratio, same. Now, simple. Quick ratio is what? Quick assets, that is cash plus marketable securities plus, you write down in that quick ratio, the numerator is called quick assets. Write down. There only you wrote the formula, no, Riddhi? You written that quick assets. Cash plus marketable securities plus. Yes, that is called quick assets. Now, quick assets is how much? 208. Then this ratio is how much? 2.6. And they are asking you current liability. How much? Simple. Current liability is 208 divided by 2.6. That's it. Okay. Simple now. Unnecessary, they have given you a lot. Just to confuse you, just to irritate you, just to dominate you. Now, next question is related. Now, same question. How much is the inventory balance? How much is inventory? Same continuing question. How much is the inventory?
So 72,000.
72,000? Very good. How?
Quick ratio.
Hmm.
Quick ratio is 3.5.
Hmm. Current ratio 3.5.
Yeah, sorry. Current ratio is 3.5.
Hmm.
And we have our current assets.
Hmm.
So current asset, we have our quick assets.
Hmm.
So asset is part of our current asset excluding inventory.
Hmm.
So I did 3.5 is equal to 208 plus inventory by 80, which is our current. And then we solve it.
Yeah. So, current ratio, how much? 3.5 is equal to 208 plus inventory
By
divided by current liability. We got it now 80. We got now current liability, right? 80 into 3.5, how much? 280, right? Cross multiply 280. 280 minus 208, inventory. 72 is very good. Missing information. Got it. These are all direct questions. It looks, they have given you simply to just to confuse you entire balance sheet. Entire balance sheet they are asking, what is it? Quick ratio. Instead of just to give you long question. But what we want? Current assets, yes, here 340, and numerator we got it here. Current liability is 170. 340 by 170. Sorry. 340 minus inventory, no? These two. Yeah. 340 minus 150. 190, no? 190 divided by 170. 1.1. How much is cash ratio? Cash ratio, not current ratio. Cash ratio is 60 plus 40, 100. 100 divided by 170. 100 divided by 170, 0.58. Cash ratio 0.58. You have only how much? 100 cash. In 100 cash, oh my god, you have to pay 94 to vendors. Yes? If they come and trouble you. And you see, interest, the bank will take it, right? How much is left now? Cash. Cash means you have only hard cash in bank 60 only. You invested 40 in the deposits. And your bank will take 30. Now, how much is left now? 30. 30 plus 40, 70. And 30 is common. If vendors come to you, again, same problem. Cash ratio shows emergency situation. How to handle emergency. Too low cash ratio means it's a big problem. Entire your operations will come to standstill. Okay. Okay, these are all direct questions. Okay. All direct question. Not going to do that. This all looks monstrous question. Entire balance sheet they have given you. All you have to do is just see what is the last question and then what is the working capital. Working capital is current assets minus current liability. Okay, current assets at the end of the year, no? Year end. Okay. Take the calculator. 10 plus 20 plus 8 plus 30 plus this is also available for sale securities. We always take it a fair value. 12. Then divide by how much is total this one? 30 plus 80, yeah? 80 minus current liability 15. Notes payable in 90 days. Yes, this is also current liability. Bonds payable 10 years. No. Okay, 15 plus 25, 40. 80 minus 40, 40. Okay, what's the quick ratio? At the end of the year, this column, remove last 3 zeros. Come on, do it. Quick ratio. Liquidity ratios are easy, basic only. We are starting a foundation today. Then we'll build up on it. Everyone agree? B, agree? B, 1.52. Got it? Okay. 1.5, 152. You got it? Did you got it? No? Help Amisha, just see. She got 0.83. Quick ratio. Quick ratio is what is it? 62 plus 35 plus 47, right? 1? 140 divided by 84 plus 11, 95. Divided by 95. 1.5. Yes. Abhyuta, I don't know how you got 100. You scared me. In online, only Abhyuta is active. Can you call it Karthik? Call it Karthik. Is the other room is empty? Check.
Is the pattern same for exam?
You asked me yesterday the question.
Then I'm worried for that. Like, conceptual, I understand to apply concept, but at least to know the type of questions, like, is the pattern at least same? Like, is it like same kind of concept to apply on it?
Pattern, changing numbers, no.
No, changing numbers, no problem. I'm saying same kind of concept, like in the missing values to one, like,
Who's it? Who's it? Shubham sir. Asking me. We can't listen, we are not understanding.
Okay.
Is there any other room?
No, all the classes are taken.
We don't know.
Okay.
It's hurting. Or maybe the door is open, I don't know. This door is open.
No, I don't.
No, there the door is open.
No, it's closed.
Tell me just slowly tell me. Tone down other class. Yes?
Okay.
like, so, or like missing value question is there.
Hmm.
Like, that question will come.
Yesterday I showed you hawk. Right? And I am doing from my sources. This is for your, I explained some issue yesterday, some theory I explained, and we did the questions. What I explained conceptually, that should be your expert. Numerical problems, anything, let it come, no.
Is the same of what questions they're solving?
Well, I don't say. You will get a, how can I say? You tell, you face that. You're not it. Similar means not similar. How can I say? No, what I know, I'm a valuer, I'm a question contributor for IMA. These are all the research-based questions. What we do in classroom, what you do in home, right? Those cement your knowledge. I will not say pattern or similar. The questions on that day is application questions. Little bit pattern may be same. To your specific question, yeah, little bit pattern may be same. But yes, it will test overall your whatever you learned questions. And techniques are also there. You have to implement the techniques like reading questions, STEM, understanding what is the requirement, handling the questions. Definitely, there is no single pattern. Definitely, there is no similarity. There are 2000 questions in Hawk. In my classes overall, during the training, you will do around 500 questions. I guarantee you, nothing, one also you will not get failed. On that day, what you get is different, what she get is different, what she gets. Everything is new. Everything is like when you see it, oh, okay, you should enjoy it. Okay, okay, okay. Numbers will be different, the theory will be different, everything is different. But you will know if you seriously, you have mastered the concept, and only then you have to go for exam, of course. Then you should smile. Okay. Exam is tricky. Very rarely some students tell me, this is also the fact, and they said, sir, exam, very tricky, and after passing also they will tell. I really enjoyed. It's just application questions. Yes, of course, calculator is allowed. The same calculator is allowed. Simple calculator. Yes, simple calculator, not scientific calculator, and of course, no code. But if you do hawk thoroughly, but again, when I say directly don't attack the questions. Concept. Once you have a strong hold. See, now this current ratio and all these things, half an hour actually it is. Yeah, but I'm going very deep and telling you all the story. Right? Then only it will cement in your mind. I asked many times, are you happy with 5129? First you said happy, then I said no. I proved you when you should be happy. That is called the concept. Okay. All of the following are included when calculating acid test ratio, except means 3 are right questions, 3 are right answer responses, 1 is not. Which is that?
Certificate deposit is a
Certificate here. That is a short-term investment. Prepaid insurance. We don't include that in quick ratio. Now this is application question. Immediately you understood. No. Prepaid insurance comes in current asset, current ratio, not in quick ratio. Okay. Now you tell me, you like theory? Go ahead. A company's cash ratio will decrease when? Mandridi. For example, purchase commercial paper means commercial paper is a short-term investment. Material on account means credit purchases. When it will decrease cash ratio? When it will decrease ABCD situation? When cash ratio will decrease? Numerator, denominator? No. Numerator and denominator, both answers there in numerator also, denominator also. Numerator decrease, denominator same, cash ratio comes down. Numerator decrease, denominator increase, cash ratio will come down. Any ratio for that matter. Tell me how. Go one by one. See,
The commercial paper is a investment.
investment. When you purchase investment, what happens? No, we concentrate on cash ratio.
Your
Push.
marketable securities will increase and your cash will decrease.
Super.
That is
Okay, wait. What happens to denominator?
sales.
That means what happens? Constant.
Nothing. It's not
No change.
Yeah.
Cash ratio, no change. Right?
Yeah.
No change. Next. When you purchase material on credit,
Your liabilities increase
liability increase,
and
assets also increase, no? You buy inventory. You buy inventory.
but inventory is not part of cash.
Inventory is not part of.
Asset, but current liability increase.
No, nothing happened to
Cash.
cash
But liabilities
increase.
increase.
So cash ratio comes down. Cash ratio comes down. Denominator increases. Yes.
Yeah.
Denominator increases. Cash numerator not affected. Cash plus marketable securities. So ratio will come down. Answer is B. That's it. Very good.
So we had a meeting of C once.
Hmm?
We had a meeting of C once.
C. Sells goods for cash. Cash will increase. Inventory will come down.
Yeah, I don't know what
Whatever it is.
that's not.
That's it.
Just look at cash as the
Cash increase. Inventory comes down. Yes. No change. C. No change. Yes. Receives cash. Okay. Receives cash. Cash will increase. By issuing short-term notes payable, current liability increase. Cash increase, current liability increase. No change. So B is answer. B is answer. The primary reason for this preference is that in analyzing short-term liquidity of a firm, many analysts prefer to use quick ratio rather than current ratio. Why people don't use quick ratio more than current ratio? Super. Conversion of inventory into cash is less reliable. Difference in current ratio and quick ratio is inventory. Now, when evaluating the liquidity of 3 potential customers, which one of the following conclusions is correct? A firm has gathered the data from 3 companies applying for credit as team customers. Company extends credit to customers, blah blah blah. Okay. Company is analyzing 3 customers, F, G, H. Okay. Which customer you take it? Which customer you will take it as a credit customer? You are giving credit.
Yeah.
And you are evaluating customers' ratios. And you are evaluating customers' liquidity position. With which customer you will deal with it on credit? You will sell the goods on credit. Which customer you will take it Now, you have to check the liquidity ratios. Okay, first of all, you need to be smart. A, B, C, D. When you D is long-term debt to equity, D is not the answer. That is not the liquidity. It's not. Now, low current ratio maybe. Low debt to total assets, no. D is out. That is not short term. Not short. Debt to total assets they are telling. So it's not short term. Highest current ratio, but maybe it is A, maybe it is C. Which one is correct? Okay, let's check the current ratio. Current ratio of F, G, H. Take the calculator. 230 divided by 175. 230 divided by 175. 1.3. Here, 129 divided by 64. 2.01. 584 divided by 142. Huh? 4.11. Okay, now. Okay, listen. Company H, A is telling company H has a high current ratio. Yes, high current ratio. But lowest asset, let's calculate quick ratio. Quick ratio except inventory, right? 60 divided by 175. Calculate. 60. 20 plus 40, 60. 60 divided by 175. 0.3. Next, 12 plus 75, 87. 87 divided by 64. 1.35. Anyway, next, 230 divided by 142. 1.6. A is telling company H has a highest current ratio, lowest acid test ratio. No, it is 1.6. No, here 1.35. This is lowest. So A is wrong. It should be C. F has a low current ratio. Yes, among all low current ratio. So the firm should not accept a company F, because if we deal with F, no chance of getting our money. So you should not accept. With whom you will work? Which customer you will accept? H, no? H is having highest current ratio and also highest quick ratio. Yes, you will love to work with H on credit terms. Okay, this is the liquidity ratio. We'll take some break and then we start an extension of liquidity ratio called activity ratios. Activity ratios. After the break. After break. Actually, it's an extension. Extension of what we are talking now in liquidity, but more deeper. Okay, let's take break. So next set of ratios, activity ratios. So we'll be going into very deep of liquidity ratios. What we did just now, these are basic liquidity ratios. Here we just understood how these will be, what is good for us, how we are doing compared to our competitors, how we are selecting our customers, what problems finance manager will have if cash ratio is too precarious. All those things like a basic diagnosis, doctor checking basic issues, right? Holding the pulse, short-term working capital needs, liquidity ratio is like a small MBBS doctor, still not become doctor, understanding the patient. So, as a finance manager, you understood your company, the Tosh Enterprises, whatever it is. These are the liquidity ratios, is the basic thing. And now, little bit, you finished your MBBS now, you are a doctor. You are a finance manager, but you are a finance doctor. You have to manage the ratios, you have to go in a deep view of liquidity ratios, that is called activity ratios. Activity or operations ratios. So, an extension of liquidity ratios, these ratios aims to understand the situation further and take the control of the situation. In liquidity ratios, liquidity cash flow ratio and all, Abhyuta, they will give directly cash flow. Okay, don't worry about that. Just a numerator denominator they will give you. Just calculate it. It's not of significant importance. Activity ratios. What are the activity ratios? These talks about handling what we know as operating cycle. Write down. Activity ratios. Shows. Activity shows or measures issues around an organization's, apostrophe S, an organization's operating cycle and cash cycle. Operating cycle and cash cycle. Oh, now what is operating cycle? I just, if you all recall, when you said 12 months, I said no, 12 months or one operating cycle. So current assets, current ratios, current assets, current liabilities, clearly how we should define. As a professional accountant, current assets are the resources, short-term resources held in the entity for a period of 12 months or one operating cycle, whichever is longer. But question remains, what is operating cycle? Operating cycle is I'll give you notes, just listen. Operating cycle is a time period when the company purchases raw materials on credit till cash is collected from credit customer till cash is collected from account receivable. Right down. It's a time period. It's a time period from the date of purchase of raw materials on credit till cash collection from credit customers. Cash collection from credit customers. Okay, so that means there are so many things happening during this period. Suddenly it will not happen. First you will purchase the raw materials. When you purchase the raw material, what is the journal entry? When you purchase the raw material from supplier on credit, what is the journal entry? Accounting entry, debit, credit. What you debit? You purchase the raw material on credit from supplier A. Supplier account. Okay. Then raw material comes to your stores. You keep it there. You draw that items, give it to plant production. They will convert the raw material. At any time there is a work in process, semi-finished, and after that it will become finished goods. Then you sell your finished goods to your credit customer, account receivable created, and then after credit period your customer will pay you or you will collect from the customer.
Till 1 day. The operation cycle will be only for 1 day. Is that possible by any chance?
Possible if it is very quick conversion.
Is that also part of the
Well, everything happens in 1 day, you are telling? Like purchase of raw material, converting into finished goods and selling it, and collecting also,
It can be for a product, but not for the business.
not for the business.
I understand the business related.
Business is because what is the time telling? You have to collect from your credit customer also. That may not happen in 1 day. It can be within 12 months or more than 12 months. So now you told one journal entry. We debit inventory, credit supplier. When you collect from your credit customers, cash is coming in. What is the journal entry? Cash account to credit, debit, data, the customer. So until that process, it is called operating cycle. This operating cycle can be within 12 months or more than 12 months, but generally whichever is longer means operating cycle or 12 months, whichever is longer. Generally in many industries, operating cycle will be longer. For example, in wine industry, in food processing industry, commercial grapes needs to be grown in a specific humid, specific conditions. It's not grown in every soil. And then that itself will take you some years, and after that grapes should be ripe, and then it should be sent for wine beverage industry, etc. Oh my god, sometimes more than 2-3 years it will take for a wine to be produced. For such a wine brewing company, raw material is commercial grapes, and they have a grape farms. For them, all those process will be over, means operating cycle will be more. For such companies, current assets, current liabilities can be more than 12 months. So this entire cycle, like this, from raw material purchase, then it will become direct labor and machine, it will become work in process, this stage, and from work in process to finished goods. And finished goods, when you sell it, AR is created, and cash collected from AR. Cash from AR. This 90% or 80% dosa, it is called operating cycle. Not 100% dosa. When you do dosa like this, sometimes not experts, we do, it will become 80%. No, that is called operating cycle. Okay, now how to calculate operating cycle? Now this area, from raw material to work in process to finished goods, this area is called DIO, days inventory outstanding, and finished goods to AR, and generating cash, this area is called DSO, days sales outstanding. Write down, operating cycle is equal to DIO plus DSO. Okay, now how to calculate DIO? Now you make one big, we will write formulas here. So here I am going to just watch me, then you arrange your page accordingly. Inventory related, DIO, and turnover. For example, DIO means, write down here on the days inventory. Before you start the table, write down days inventory outstanding plus DSO, days sales outstanding. Days sales outstanding. Okay, now just plan your page accordingly. Just a minute. Turnover ratio. First I will write here, then you plan. There are two ratios we have to write. How to calculate DIO? DIO is equal to average inventory divided by cost of goods sold, COGS, into 365 or 360 days. I'll tell you what is the 360 days. Turnover, inventory turnover, is equal to COGS divided by average inventory. Average inventory. Now, AR related, DSO, turnover. Okay, DSO is equal to average AR divided by credit sales into 365 or 360 days. Here, AR turnover is equal to credit sales divided by average AR. Okay, now you can plan your pitch, right? Use a scale if you have and write down them. Inventory related DIO days, inventory outstanding, how to calculate that? Average inventory. Average inventory divided by cost of goods sold. COGS means cost of goods sold. Because inventory is what? Raw material, work in process, finished goods. Everywhere cost is flowing through cost of goods sold. Sales minus cost of goods sold is what? Gross. Okay. Into 365 or 360 days, depending on the question. If the question is silent, you should use 365 days. 365 days is known as a calendar days. 360 days, specifically they will write, use 360 days. What is 360 days? It's a business days. Yeah. Very good question. I was about to tell. In America, just now, July 1 was holiday. Then it's like their Independence Day. Then there is a Easter. Then there is a Memorial Day.
Basically,
Public holidays. 5 days. There are many Christmas, many days holidays will come. They also have around 30 days holiday. Okay, but these 5 days compulsorily except emergency services. No company should work. Labor law is very strict. Here in public holidays also we work in India. Actually, it's against the law. In America, these 5 days, any plant, let them open. Labor inspectors will come and put a fine. Independence Day, Memorial Day, Easter Day, Thanksgiving Day, another one I forgot. These are the must. Only emergency, hospital, fire engine, all those things they are working. Police. Okay. Another way to understand is how many times inventory has been turned over into generating cost of goods. What is this average? Average means beginning inventory plus ending inventory divided by 2. January 1 beginning inventory, December 31 ending inventory. Write down. Average means beginning balance plus ending balance divided by 2. Why we need that? Why we have to do that? Your cost of goods sold is from day to day, no? All 365 days you have, this the cost is going on. Cost of goods sold is being catch. It is being accounted. It is a day-to-day activity. Sales, cost of goods sold is a day-to-day activity. Already we are taking that. But if you take ending inventory, that's not correct. In the question, you don't have two balances, then you should take ending balance. If you have both balance sheet, definitely you should average it. As far as AR, same thing, but AR is related to credit sale. I just now said you sell customers on credit. Sales is of 2 types. One is cash, one is credit. When we talk about total sales, it comprises cash sales and credit sales. These supermarkets, e-commerce, B2C. What is B2C? Business to customer, it is a cash sales. B2B, what is B2B? Business to business, it is a credit sale. So, any company cannot say, if you go to the supermarket, everything is cash sales. But that is B2C. But supermarket has a B2B contract with the distributors, suppliers. They work on credit sales. Just a second. ಹೇಳಿ ನಾಳೆನಾ ಯಾಕೆ ಲೇಟು ನಾಳೆ okay, so that is why credit sales, cost of goods sold, all this is for the total sales. There is a cost of goods sold because inventory is cost to produce. There is no credit, etc. Okay, so but when it comes to sales, especially when we are selling on credit, of course, selling on credit is AR, not collected portion is AR. That is directly related to credit sales. That's why yesterday only I said, you should not memorize the formulas. This is the link, this is the concept. Average inventory, if you start remembering average inventory divided by cost of goods sold into 365, 360 days, average, correct. Yeah, this is a common sense. I don't advise you except a few when still we have not started. If there is something, maybe out of 35 ratios, you will be remembering only memorizing around 3 to 4 ratios. Should not remember. These are all logical relationship. And now, with the numbers, you will understand. Inventory, another way to understand operating cycle is number of times. Here it is days. This is days. DIO means days. DSO means days. But turnover, when we talk about inventory turnover, how many times inventory is turned over into generating X amount of cost? How many times AR is turned over into generating X amount of credit sales? Faster, slower, and how it is related to number of days. One thing is clear. Before we start the numbers, one thing is clear. Just to imagine, I did not tell you. As a finance manager, before any start, I'll ask you one question. If your company's operating cycle is high, everyone understand? If your company's operating cycle is very high, large number of days, will you like it? No. No. No? Yes? No? If your company's operating cycle, which is days inventory outstanding, days sales outstanding, is very large. Let's say out of 365 days, if your company is taking time of 200 days from the date of purchase of raw material till the date of collecting from cash from customers, your competitor is doing in 120 days. Are you doing better or are you doing worse? Worse. You are taking 200 days, right? Your competitors are taking 120 days. Finish it off. They are getting cash also in 120 days from customer. They are producing, converting raw material into work in process, shipping the goods to the customer. Customer waiting time is over. They are collecting everything. It is done in 120 days. And you are taking 200 days. That is why in your liquidity ratio, in your current ratio, account receivable is high, inventory is high. Are you getting it? Now you got it? Link, you got it? That is why the extension of liquidity ratio. All these things they will not write in books. Only Bala sir notes. Before I start, you now got the idea. We struggled at the start of the session today. 5.29 is high. No, you sleep, you happy. No, that. Oh, finally you said no. Quality, inventory is high. AR is high. Not good. You all said. Why inventory is high? Why AR is high, my dear, in your company? Operating cycle is long. Got it? That means something is wrong in your company. Your competitor is also selling same product. You are also selling same product. Why you are taking 200 days? There is a problem. This is why this is problem. You will become surgeon in section B. You will go deep in section B. One by one chapter, you will handle AR, you will handle inventory. You ask, come on, sales manager, come on, shipping manager, come on, production manager, purchase manager, come here. Why it is 200 days? You start doing surgery. You will become finance surgeon in section B. Now in section A, you are a doctor. In liquidity ratio, you hold the pulse. In activity ratios, you are prescribing. In section B, operating surgery will do. That is the link. Now, before we start, now you are all understanding. Before we start, number, write down. If operating cycle is long, right? Compared to industry average, then inventory and AR levels will be definitely high. Next,
This is because the statement says comparative industry average. Then who decides the industry average?
I like this question. In America, when they give you questions, here, retail. If your business in retail and grocery, industry types, manufacturing industry, technology industry. This is the industry averages.
Country based.
In US, industry based. These are all industries, right? Retail and grocery, manufacturing and wholesale, technology, software, banking, financials. Yes, that is why we call it as industry average. For example, pharmaceuticals. If you are in pharma, see, not government, industry. Nidhi, if your company is in pharmaceutical company, you come under pharmaceutical industry, yes or no? If your company is a technology, you come under technology industry. This is a training industry. So, each industry has a different current ratio, different liquidity ratio, different cash ratio. That is why I am using the word industry average. In the exam questions, they will give you this average. In the background, they will write ABC company is a pharmaceutical company. Calculate liquidity ratio and compare this averages. They will not just give you blind averages. Okay. Every industry has an industry average standard.
And it's different in every country.
Yes. because the environment is different. In India, it is different. Same pharma, India is different. This is American exam, American. Okay. See, in pharmaceutical, you should keep lot of cash ratio. 2.2 to 2.5. Okay. 1.3. Did I answer your question? Niti? Now, what did I say the last sentence? Definitely high. Next bullet point. Therefore, efforts should be made. Efforts should be made to reduce DIO, DSO, and operating cycles. Okay. Now, leave some half page there. If we get additional points, we will write. Now we will start the questions. Later on, I'll explain cash cycle. If we link this point, if we complete the cycle, it is called cash cycle. That is, a cash cycle also includes a concept called DPO, days payable outstanding, accounts payable. Okay. Now, for example, this is a direct question. What is the inventory turnover? By the way, turnover means number of times. I said number of times. Inventory turned over into generating X amount of cost of goods sold. Inventory turnover year 2. Okay. Inventory turnover, what is the formula? Cost of goods sold divided by average inventory. How much is cost of goods sold in year 2? 330. 330. Cost of goods sold. 330. Divided by inventory balance sheet side. Inventory 90 plus 80 divided by 2. By 2. 85. 85. 330 divided by 85. 3.88 times. X means times. 3.88 times. Okay. Now I'll give you one shortcut, also long cut. DIO. What's the normal formula? Reverse this, no? Average inventory 85 divided by cost of goods sold 330. Question is silent. We will use 365 days. How many days? 85 divided by 330 into 365. 94 days. Now, if you know 3.88, if you know the turnover, you can do other shortcut. What is that? Take calculator. 365 divided by 3.88. You should get 94. Check. This is an alternative easy way. But first you should know turnover. If you know the turnover, 365 days divided by. If question asks you directly DIO, then you have to use this formula. Shortcut. Shortcut, long cut. Now, let's do AR turnover. Credit sales divided by average AR. Now, they have given you sales here. They are not talking about, let's assume 480 is a credit sales. 480 divided by AR 68 plus 48 divided by 2. How much? 58. How many times? 8.27 times. 8.27 times. Okay, DSO 58 divided by 480 into 365. How much? 44 days. Or 365 divided by 8.27 should get 44. Now 94 days plus 44 days is equal to operating cycle. How much is that? 138 days. We don't know here industry average. If already I talked about it. If your competitor is doing all these things, what is all these things? Operating cycle, date of purchase of raw material on credit till the cash is collected from customer. If your industry, if your competitor is doing everything in 100 days, then there is some problem with us.
If he's doing it in less days, what's the problem?
If
100 days.
100 days competitors, everything they are doing it. We are taking 38 days extra. No? That means we are having some issues. Maybe our policies are not good. Maybe our people are lazy. Something happened. Sales documentation may not be good. We are taking long time in the production process. Maybe we are. Huh? So what? What is important? If money is not there, you will struggle to run day to day. Okay, product is good, but your competitor is also doing good business. Then competitor will not be there. No? If your quality is so good, you cannot tell in the market, my quality is so good, but I am taking more time and you will also give me in more time. How do you say? Nowadays customer what? Customer want right quality, right time, right price. But it is your duty to collect from customers. Customers will not pay until you ask. That means there is some problem in your plant. They are taking long time. And there is some problem in your department. You are not collecting properly. You are not following it up with your customers. So all these systems, processes, you should change. Okay, if your product is good quality, but what is good quality? If the money is not coming, How do you survive? You have to go to the bank loans. You go to the bank loans, get the loan, and pay salary, pay accounts payable. Is it a good working capital management? You are increasing the cost also, right? If you go to the bank loan, you have to pay interest, you have to repay, correct? Again, current liabilities will increase. Having your own money with the customer, you are not collecting it. And then you are going to short-term bank loan, increasing current liability, then paying accounts payable, then paying salary. Are you a good finance manager? You are increasing the cost of funds for the company. So 138 days. Now, mathematically, now you see the relationship. One thing is clear. Whatever be, even let's say we are 98 days and our competitor is 100 days. We are doing good. But still we can reduce, no? Yeah, we should aim at 90 days. Correct? Operating cycle less it is always better. But how to make it mathematically? Now, look at this denominator. This denominator 365 we cannot change. I want to reduce 94. Now, denominator I should increase or decrease? Tell me. I want to reduce 94 days, correct? 365 numerator I cannot change. Denominator I should increase or decrease? To decrease 94 days. Increase. So, if the denominator, let's say, is 6, 365 by 6, how much? 60 days. 34 days you are reducing, no? Yes? That means what? Desirable inventory turnover is faster. Inventory turnover, AR turnover should be faster. Then the days will come down, operating cycle will come. When we fast turnover inventory, raw material working process finished. 6 times we are changing it instead of 3.88 times. Automatically, look, 30 days will come down. That means the problem is the plant. Raw material working process very slow. Working process to finish foods very slow. That means we are using old technology, no automation. Cost of goods sold is also not coming down. Yesterday we talked about cost of goods sold. Remember? See, yesterday's, today's, everything is linked. Write down. Desirable. That's why I told you, leave some space. Desirable is to increase. Desirable is to increase inventory turnover. And AR turnover. So that DIO, DSO, DSO, and overall operating cycle comes down. comes down. Mathematically it is okay, but how do you do it? That is what secret is in section B. In section B, as a finance manager, how do you do it? Okay, go ahead. You have been given current ratio, quick ratio, year-end current liability 600, beginning inventory 500, inventory turnover 8. What is the cost of sales, or what is the cost of goods sold? How much it is? How much is cost? Use the information formula. Inventory.
The year-end
No, current liability, simply. Use the formula, inventory turnover formula, use it. I am giving you clue. I will do it, but I am giving you time to. What's the inventory turnover is 8, right? 8 is equal to cost of goods sold, we don't know, divided by average inventory. Yes? Okay. Now we have to find out average inventory. Beginning they have given you 500 less. Ending we don't know, divided by 2. Okay. Ending how much? Inventory. Huh? 300. Ending inventory how much? 300. How? Quick ratio.
Both side. Quick assets.
You minus that. Okay. So current ratio 3.5 is equal to current assets divided by current liability. Current liability is 600. Therefore, current asset is how much? 600 into 3.5? 2100. Quick ratio 3 is equal to quick assets divided by 600. 600 into 3,800. Difference between these is inventory. Ending inventory 300. Yeah, so 300. 800 by 2, 400. Right? So we got 400. Therefore, cost of goods sold is 8 into 400, 3.2 million, 3. Still a shortcut, huh? Still shortcut. Very quick in the exam. How you should do? First understood this one? Understood. Still shortcut. Stalin, everyone. Just see. Main difference between current ratio, quick ratio is 0.5, right? 0.5. 3.5 minus 3. 0.5 is inventory, no? 0.5 into 600. 300. This 300, how we can easily get it? Difference between current ratio and quick ratio is what? Inventory, right? Inventory is 0.5. 0.5 into 600? 3.
So, into 600.
Yeah, anyway, we are doing into here, right? 3.5 into 600. 3 into 600 we are doing, no? Instead of that, 0.5 into 600, 3. Split seconds issue. Getting it, Abhita? These are all long cut. For home practice, it's okay. But when you're practicing, you should develop your own shortcuts. I am giving you sample, but you should tell me, sir, in this way we should do, we can do it. No, you should ask. But it will take time. It will take time to develop your own shortcuts. Now, come back to this page. Come back to this page. If you, I told you to leave some space. If you don't have, write separately. AP related. Accounts payable related. We will calculate DPO and payable turnover. Payable turnover. DPO, average AP divided by credit purchases. Or you can take cost of goods sold into 365 or 360. I'll explain what is that. AP turnover, credit purchases divided by average AP. Now, first write down, I'll explain. No separate questions will be asked on DPO, but only concept as far as cash cycle is concerned. Okay, wrote down. Now, this portion, if we complete this portion, Okay. Now I am connecting this portion. This portion is finally AP paid cash, AP to cash. After collecting money from customers, we pay to suppliers. This portion, green portion, is called DPO. Now, what is cash cycle? Cash cycle is nothing but operating cycle minus DPO, right? Operating cycle minus DPO. Already we know operating cycle, DIO plus DSO minus DPO is your cash. Minus DPO. If you do minus DPO. No, if we deduct DPO, then it will be cash. DPO is not cash cycle. To arrive at cash cycle, we must deduct DPO. Days payable outstanding. DPO stands for days payable outstanding. Okay, now I'll come back to this question. Either you can take credit purchase. AP means credit purchases only. You are buying raw material on credit, then you are creating AP. But if you are not able to calculate credit purchases, you can take cost of goods sold. Okay. Now let's take cost of goods sold. DPO. DPO. Here turnover, no? Here DPO. DPO. Average AP how much? Here in current liability. 70 plus 42 divided by 2. 112 divided by 2. 56. Anyway, we'll just take cost. Okay. 56 divided by cost of goods sold 330 into 365 days. How much? 61 days. Operating cycle 138 minus 61. How much? That is cash cycle. 138 minus 61. 7, no? 77 days. Here. 138 days minus 61. Okay. 77 days is your complete cycle. What is complete cycle? Raw material purchased on credit with the payment of creditor. Once we finish payment, complete cash cycle. One 38 days is operating cycle.
So does cash cycle say?
Sorry?
Like how operating cycle we said that it should be less, it's good if it's less. So what is
Cash cycle also should be less. Cash cycle also should be less means your AP turnover should be high. Sorry, your AP turnover should be low. Here AP turnover how much? 330 divided by 56 how much? 5.8. Okay, right now. Cash cycle refers to time period from Date of purchase of raw materials on credit till supplier gets paid. Till supplier gets paid. That means raw material purchase. Converting work in process. Here the cycle. Cycle what? Raw material purchase. Converting work in process. Shipping the goods ready. Finished goods ready. Shipping goods to the customer. Credit customer. Collecting the money from credit customer. And then paying to accounts. All. Now, what is desirable? Of course, the shorter cash cycle is always good. Like a shorter operating cycle, shorter cash cycle is always good. The more money you collect it and pay it, finished off. Then your suppliers also will be happy. They continue to supply to you. But little bit delay you can do. Reasonable delay for suppliers you can do. Supplier should not be keep on waiting. Now you are taking 61 days to pay your supplier. Maybe you agreed with your supplier 45 days only. You are already delaying. Too much delay means supplier will get angry. 21 days. Also, when you agree 45 days, you are already delaying, no?
So less than the accounts payable turnover, faster we are paying the supplier.
Yeah. What is the desirable? We should not pay faster. We should delay. Reasonable delay.
But we want our cash cycle to be lesser.
Yes. How to make it cash cycle less? DPO should be longer. Should be longer. DIO, DSO should be shorter. Yes? Yes? Days of inventory outstanding, days of sales outstanding should be fast, should be lesser. With the operating cycle only, you should reduce cash cycle. Both should be less. Now, write down. Now, are you all understanding what we wrote? Desirable. Wait. Desirable. All of you understood. Desirable is what? DIO should be less. Yeah. DSO should be less. So operating cycle should be less. To make that happen, what did we say? Inventory turnover should be faster. AR turnover should be faster. Now opposite will be DPO. Right down. DPO. Days payable outstanding should be more. Comma. AP turnover should be less. AP turnover should be less. Okay, 61 days if it become 70 days. 138 minus 70, how much? Huh? 60. 68. Good. So the moral of the story is both operating cycle and cash cycle should be less. He-
How do we say, why do we say they say counseling should be more?
Yeah,
Like, I know mathematically that will result.
yeah. Why? As a finance manager,
Why?
I'm telling you, as a finance manager, you should delay. Delay means you, no, wait. Delay means you conserve the cash. Conserve the cash in the
Like,
company.
you have to.
Yeah, check is ready, but don't give. Means if you give it, money is gone out of your company, right? Anyway, suppliers are with you in your business on credit. You say, I'll give you next week. I'll give you next week. Benefit means we are conserving cash. Yeah, in emergency situation,
But it doesn't going to go right anyway.
that also going to go pay after 2 weeks. Until the supplier get angry, I told. Until the supplier put a gun on you, supplier will warn you. If you don't give me, I will cut the supplies. Until that situation, that is called unreasonable delay. You should not.
Basically, it's good for like outsiders to see that we have cash with us.
Yes. AP can be more. AR should be less. AP denominator, right? Current liability, AP. Denominator more is always good, no? If you are a finance manager, you will say, come, all the suppliers come here. I have agreed for 45 days. I will give you in 30 days. Will you do? Mission. Hello. You agreed with your credit suppliers 45 days. You call all the suppliers on 30 days. Come. I'll give you check. You should go and collect from your customers early. Pay later. Working capital motto should be collect early, pay later. Last line, you write down. Last line. Nidhi, write down. Working capital motto. Collect early, comma, pay later, comma, invest excess cash in marketable securities until that point. You should not do. Reasonable license. If supplier gets angry, supplier will not supply to you, then you will lose your job. No? Your general manager will get angry on you. Right? They will go and complain to your general manager. This Nidhi is delaying too much. Until that time, without knowing your general manager, you should play. You should be good actor. You should cry in front of your customers. You give me check today, or like that you should. Crocodile tears you should do. But when your suppliers come, hey, change the voice, put the baseball cap and run away. Your accountants will tell, no, ma'am is busy in meeting. She has to sign. After that, boss has to sign. Come next week. Until they get angry. Finally, you have to pay. Why this is important? Delay means you're conserving cash. Any emergency in your plant. Should conserve. Being finance manager means big actor. I have done all my life. I was in business trip and I came back. My accountants, I trained them to be liars, tell lies. Telling lie for a good cause, conserving cash is always truth. In Mahabharata, Krishna says same thing. Tell lie, he says to Yudhishthira. Ashwatthama Hatha Kunjara, you say, he will say. Means that Dronacharya is killing everyone. Pandavas will be killed. Right? Dharma will not be started. So what he says? Tell this lie. The Dharmaraja, he don't want to tell lie. But if he doesn't tell lie, everyone will go. So what he says, Ashwatthama means Dronacharya's son. Hatha Kunjara means when that dad hears Ashwatthama died, he will leave the Uttama. But what he says, Hatha Kunjara, an elephant named Ashwatthama I killed. By the time he will do like this, Shank. So Dronacharya hear only one thing, oh, my son died. Actually, to stop that, the Krishna play Natak. He will tell Yudhishthira, you don't want to tell lies, right? I understand. But tell like this, by the time he will blow that. So Yudhishthira said, I told, named one elephant died. But because of the, otherwise on that day only, all Pandavas would have been killed. Mahabharata would have ended. He stopped. Telling lies for a good cause is always good. I trained my accountants. She was telling, she was Arabic. She was telling, no, my boss is in Paris, he is coming. He will sign tomorrow. He was already angry. But unfortunately, what happened? I don't see any suppliers. Unfortunately, in the same elevator I am there, he is also. And he is talking in Arabic with my accountant. She is telling him lie, but he says, I catch your boss here. Then he came to me, I said, don't get angry. Just now I came and signed it. Until that time, you should. That is the art of finance, art of working. You should not be so truthful to suppliers, come on. But you should also cry in front of your customers. $4 million, I went to Aramco. I said, boss, if you don't release my 400 people's salaries, I cannot pay. Please, please, please. Full day I sat there. Got 4 million transferred. Cry. They were playing, oh, another boss should come. He said, where is your boss? I wait. Personally, I used to go A-class customers. That is called finance management. Okay? Let's stop here and then continue tomorrow. Oh, now what today is something new. Okay, scan, come on. Start scanning. Immediately. Yeah, you can leave after scanning. You can leave. Okay.